Okay, now let's just sort of crack into it. The setting up and managing a long-term trade. Right now, there are components of this in the masterclass course, but it's quite relevant to what's going on right now. Okay, and what you want to be able to do. And we had a great example, like last Friday, US non-farm payrolls, pre-payrolls. We had a situation where there's a lot of volatility around the unemployment numbers. But with the market turning, right, and what I'm talking about is the US market, all we're looking for is that last nail in the coffin, to be honest, with US data comes out weak. We get confirmation that the Fed are going to be on their aggressive interest rate cutting cycle, and that can change the whole momentum of a trading opportunity, right, or of an instrument. So, and the easiest one to look at as a reference point is dollar yen, right? So you go back to 2021, we're sitting down here around 104. I got to say, around this time, like when I was, back when I first started in the market, dollar yen was forever around 145, 150, 160. That's where it spent most of its time. And if I just come back and get some more data here, hopefully you'll see that. And so for us, having dollar yen, 2010 around 75 was completely insane. But you know what? That's what the markets are, right? So this is what I'm talking about. Back in the early 90s, when I first started trading, we were sort of around here. And and when I was in London, I was the head trader for yen at Citibank in London. We had like massive turnover, right? And we're still sitting around these current levels. So where we are is no surprise, right? And it shouldn't be to anyone, actually, if I just wind this back out. Now, let's just have a look at this, because what we want to focus on is not what dollar yen's doing, but the trade, a long-term trade. So you can see how far this thing's gone. From 21, it's gone up, up to 60 something, 62. Like that's a hell of a move. Now, what we are looking for is to get into the move on the downside, right? When this turns. And there's been a couple of things, as I was saying last week, sort of in that trade alert video I put out. And this is where I had quite a few traders asking me, like, how do we get into this trade and how do we manage it, right? Well, with a long-term trade, there's a couple of things, right? First of all, you need a defining moment in the actual trend of the data that lines up with what the central bank is talking about. Now, using a tool like this LSG, this interest rate probability thing, it is a bit of a gimmick, but it does give you some insight into what's going on. Now, we have been looking for the Fed to start their cutting cycle. Now, there's a 57.5% chance, as far as the derivative market goes now, for a 50-point basis cut. Right, that's pretty good. That's pretty big, right? The way they do the calculations here is a little bit weird, because they've also got to cut 0.25, only 42%. Well, it's definitely 100% they're cutting by 0.25 and 57% here. That's just the way they calculate this thing. So we can see that the Fed are, on a cutting cycle, and that's where we were coming into the last meeting. And you can see here the implied rates, basis point moves, it's coming down 200 basis points almost by next year, right? So that's a good sign. So what does that do for us? It gives us a clear direction for the US dollar, as in down, especially against the yen. And this goes in line. So we're looking for defining moments. Okay, the US non-farm payrolls is one of the key data releases that the Fed uses as an indication of economic growth, activity, and then you've got the inflation numbers as well. So what you need, and it is very rare to get the turn, right? That's very rare. Like, you're not going to be able to sort of pick the top here of a long-term move. So what you're looking to do with a long-term trading strategy, right? You're looking for the fundamental shift. Now, there's two instruments involved here: the US dollar and that's a bit terrible writing. The US dollar and the yen, right? So the US dollar, we're looking for the nail on the coffin, the US non-farm payrolls, give it a real kick to the downside. We have seen the Bank of Japan hike rates, first time since day dot. And then also at the same time, you know, a lot of the global economies are rolling over. There's this issue about global growth. So a bit of a race to the safe havens, the yen being one of them, right? So the yen, and then also the Fed, about if we get weak numbers, we get this weak dollar and the whole picture starts to form shape. Now, so what I'm saying is you're not going to get the initial move. Now, if we looked at a microcosm here from 2024, okay, we have seen, you know, a good 20 big figure move. You could be looking for this move here. Now, there's two parts to dollar yen, a little bit different to the other pairs because we've got trend lines and we've also got the cloud in play, right? So it gives you a couple of clear options. If it's definitely in the yen, in the Japanese session, I mean, the cloud is in play, and that's, you know what, it's become prominent across most of these sessions as well, right? Japanese traders are up all night trading this thing, so you can be looking at this. Now, there's this trend here, and we have seen, you know, you see little breaks of this trend all the time, right? So you're probably not, I mean, even though you're identifying where the support is there as well as the cloud, you're not necessarily into the long-term trade here. When you are looking to get a long-term trade on, you're looking for absolute no-brainer. Yes, the trend has turned, right? And that's where the non-farm payrolls comes in. So really, are we getting in here? No, right? You could for a short-term trade, but that's where this green trend line comes into play. And we're looking for that. Now, non-farm payrolls. This was the key event. You're looking for a key fundamental release that the central bank refers to that is going to make the new trend change, or the current trend change, as well as, you know, confirm that this is the move. So we'd already had the BOJ and we'd seen it clean out to the downside, right? And there was a bit of a safe haven trades, but fundamentally both sides of the equation here, US dollar and yen, both fundamentally support a lower dollar yen. So getting into the trade, it's one of those ones where there's a lot of volatility. Okay, you got to recognize the numbers that are coming out. A lot of volatility around the the release of that employment numbers. So it's basic. It's very simple setup. So depending on what your trade size is, right? And let's just say you've got a 100K account and you're looking at say 10 lots, right, as your normal trade size. So if you've got 10 lots, right, on a normal trade, with a long-term trade, you are dicing this up, right? That 10 lots, maybe you've got a 25 to 30 point stop loss on that, okay, just to keep you in the game, give you some breathing space when you get into the trade. Now, with a long-term trade, right, you're sticking to the same capital management structure, right? I would be going in with half the trade because you want to give yourself some room to move on the execution and the break of this level, right? That's what we're doing with our trade plan, managing the initial entry. Once you're in the trade, well, then your trailing stops and things are going to come into play, and I'll talk about that in a second. But first of all, managing this. So normal trade size 10 lots. So I'm saying with this trade, you're going to get a bigger move. So you're still going to make more money, but you're going to have a bigger stop loss. So I would suggest, okay, say 5 lots, half your normal trade size. And with that, double, okay, go 2 times the stop loss, right? So if your actual entry level, let me just get that pen out again. All right. So if our normal trade size is 10 lots and your stop loss on that, okay, is say 25 points. Let's just give some exact numbers. If you're looking to get into this trade here, then what you would be doing is, with a long-term trade, buying yourself some safety. And what that means is a bigger stop loss. So if I went in with 5 lots, okay, well, I'm going to have my stop loss, okay, at least 50 points. Well, SL 50. You know what? And in actual fact, with a major trend level and we're looking for a significant move where this thing could go down 10 or 15 cents, it makes sense. I would almost go like, okay, I'm going to go in with a third, right? Because what I'm really focusing on here is this thing. I want to give myself some space here, manage the volatility, especially as I said, if it's around a macro fundamental, an aggressive one like the non-farm payrolls, where you've got a number of different variables. If both of them line up weak, we get a nice trade, but there's still volatility in the execution of the entry, right? Whether you're trading live or using pending orders. So in this situation, I would almost more likely go down to 3 lots or even a quarter. Okay. So that's where you're at. So you go down to 2.5 lots, it takes a lot of pressure off the system, right? So here, if we go a third, where you're looking at a, say, 75-point stop, you go a quarter, you can have a 100-point stop loss. In this opportunity, and a lot of these trades, if you have more capital, well, then you can increase the trade size because your initial trade size might be 20 lots, right? If that's 20, well, you're trading like 5 lots, okay? Long-term trade, you've got to stick to the same management structure. So with that, this, on all weighing up everything, this would be your best option. It gives you a huge amount of space to get in and then manage the position once you are in, right? So, and these longer term trades, you are generally executing off your daily charts, right? So just having a look at this, and you can see here very clearly, you know what, it came down, just pushed through the level, and then it sort of bounced. Okay, so you got to be careful getting in. So what you want to do is, with an execution of a long-term trade, you want to make sure the trade is on. Okay, now if I just have a look here, let me just get the crosshair up here. Okay, so 149.82, the key level here is at 65. I mean, it just touched that level. It got down to 146.54. Okay, so 30 points down through the level and then continued lower, came back, and it's now retesting. I still think it goes a lot lower from here, so 148. So you've got 2 options to get into the trade, and this is where you can dice up your entry. Now, to get into the trade, I would be giving it at least 30, maybe 40 points through the level. Okay, so in that case, you want to make sure that it just isn't like a stop loss jam. It is actually a real breakdown through the level. So your entry, I would be saying at least 30, 35 points, 40 points perhaps, to get into the trade, right? What that will give you is, from here, from where it broke down, a 70-point or 75-point stop loss. So that's 30. Let's go up here. Then that'll be a 70-point stop loss above the break level. That buys you a lot of time. Now, if you wanted to be extremely confident with the move, well, you'd have your stop loss above this resistance line now, which is now sloping downwards. But to do that, you're going to have a position of like 1 lot, right? So you've got to work out what you can do. So I would potentially think about doing 2 things. Break the trade up into 2 components, right? You could be, first one, look to get into the trade, say 30 points below the market, right? It gives you a stop loss from the key level here. Okay, you've got a stop loss of 100 points. So that's 70 points above the entry point. Now that's your first one. And then you let that trade go, right? We're going to have a trailing stop on that. And your trailing stop is going to be at least 150 points, right? The idea is to let the market go, right? So, and especially what you need to be weighing up on that is, are there any other levels here below this level, right? That's what we want to see here. And there was another level here just below the initial breakdown. So if I just wind that back out, you'll see here, okay, down here at 135, right? That's really your target. So when you come into the long-term trade setup, it is a matter of going, okay, do I go in boots and all, one trade? And that is not a bad strategy, especially if it just goes down and doesn't come back. But if you want to be a little bit safe and sound, right, you can break it up into two components. Your first one, 30 points below the market. And then you could have your second trade. Okay, you've got your key break level here, maybe 20 points from that level, 20, 15 or 20 points, right? And so if you've got your second trigger level here on a retracement, right? And that's what could be happening. Now, you don't usually expect a 500-point move the next day, right? That's a little bit unusual. And that's sort of screwed up a bit of the price action. But you would have, if you had the first trade, right? And I'm saying you got 100 to 150 point trailing stop loss in this situation, you've probably taken profit down here around 143 or 143 and a half. You've already locked in, 400 points or something or thereabouts. And then you're looking for the retracement, right? The trade with a long-term trading and a trend, it evolves over the course of a year, 2 years, right? This is the key factor. So what you want to be doing is using your trailing stop loss as your take profit level, right? What I would be considering also for your take profit levels on a long-term trade is the next support level, which, as I was just saying, if I can just get it back up, you're looking at sort of 135, 136, right? So if your entry point is around 147, sort of 20, you're looking at for like 800 points overall, right? To get this move, right, you don't need a huge position that jeopardizes your capital. And that's why I'm saying if your normal trade size is 10 lots, right, just reduce it, right? And plan. Are you going to go in with one trade or potentially two? Okay. Now, going in with one, if it goes all the way, of course, you're probably slightly disappointed, but you're still making money. And it gives you room to cover a retracement. At the same time, if you get into the first move, right, and you're going with one trade and you get kicked out of the trade and you take profit, you've already locked in, as I said, like 400 points. Well, your second trade, which is still a new trade, is on a retracement almost back at the same level where you got in initially. Or because that previous support trend line is now acting as resistance, you could get in a little bit closer to the trend line, and then you're back in the trade again with one trade and looking for the move to the downside. So with that retracement trade, right, you've got a little bit more luxury, and you're going to have a little bit more cash in your account if it does come back, right? As I said, a lot of the time, you're not going to take profit the next day, like 400 points, and then be getting into the trade almost back where you got in, right? You'd be like, wow, what an opportunity. Like, this is absolute magic. With the second trade, you could be looking to get into the trade. Once again, your first consideration is the stop loss. And with a long-term trade, I would still be going in with that, ideally 100 points. So how far below the market do you get in to give yourself some room? With the retracement, that's where I would be considering placing the stop loss above that resistance line and let that follow that down. Okay, so in that situation, you would just basically gauge. Okay, so where's the trend line? 149, the figure. Well, it's 200 points, 220 points. And this is where you sort of think, well, that's great. You know, if I was a fund manager with managing a couple of bill, you can have a decent sized position with a 200-point stop. But you know what? You're probably not it's still too far away. If we get to the level over here where the old support trend line, which is now acting as resistance, sort of converges with the new resistance trend line, well, then that's really in play. So with this one, managing the position, right? You're looking to get back in almost at the same point where you did the first trade for the second on the retracement. Okay. And then you're looking just to stay in the trade. With that, you know, say that's 30 points below the market. Your stop loss is going to be up here. You've got good protection, and then you're on the trade. Okay. So like the crucial factor of getting into these long-term trades, okay, and having a long-term strategy, there's a couple of things, right? First, you've got to manage the execution, the volatility of the breakdown of that trend, right? And as I said, if you've got the fundamentals working for you, it's a lot cleaner, right? As I said, we've got Japan hiking rates, the Fed ready to cut rates, and a bit of a safe haven trade. It's like on multi-levels, fundamentally, this is ready to go down. We just needed those US numbers to fit into the picture, and then you get the trade. So if you can manage the execution and the entry, survive the initial volatility, now it becomes a bit more fun, right? You've got a lot more room to do things. So that's the sort of key part. Now, trailing stop losses, you want to give yourself, and you can have a look at, say, some of the moves that dollar yen does. And when it's trending, like see these moves here outside of key releases, it actually does like small ranges. So the 150 point range will work a lot of the time. Okay, now you could change that to 100, you get kicked out of the trade, and then what you've got to be doing is proactively looking to get back into the trade. The problem is, like if we get situations where we have now, we've got trend lines. Okay, we've got a resistance trend line, we've got one at the top here, and we've got a support trend line down the bottom to get back into the trade. The problem is if you get kicked out, right, and let me just wind this back down, and dollar yen is now trading down here, right? You're now 400 points from a resistance line and, 400 or 500 points from a support trend line. What do you do here? Well, you can be trying to get in on the key macros, but it's looser. You don't have the security of the trend lines to know where selling is going to be and where the buys are going to be and where the stop losses are, right? So you've got to get into the trade at a decent level near the trend. And I'm sort of saying here, like this thing's up to 162. We're not getting into that trade until it's down here around 148, sort of 60 or something, right? Or 40. So that's 600 points from the top of the trend. It doesn't matter because there's potentially 20 big figures to the downside. And all we're going to do is manage the entry. Now, on top of that, there's one other thing you can manage. And this is the weekends, right? So the weekends can work for you or they can work against you, right? There could be geopolitical news or various things coming out. And as we come into closer to the Fed elections, you know what? Donald is a geopolitical event, right? So that could actually sort of throw the dollar around primarily because he comes out and starts talking how we're going to hack up trade policies and trade agreements with, China, everyone. Right? He's like, you know what? Let's screw everyone. That will impact the dollar. Usually what the president says or the head of state, they're usually pretty sedate, but not the Don, right? So with that, you might want to manage the position over the weekends, which means, you know what? If your position is, say the currency's here, you close the position out Friday, you come in and open the position on the Monday open, right? Have a look to see if there's any dramatic news. Sometimes it can work, as I said, against you. It could be lower, right? Or it could be higher. And you're thinking, that's good, right? I can get back into the trade at a decent level. That's something you've got to consider, right? Absolutely. Because you know what? If there is a geopolitical event, you could get the initial price action on the Monday open could be like 100-point spread and you get jammed out at a bad level and you're out of the trade and then it goes lower. So that's something to consider as well. But just getting in, managing the positions, it's very easy to manage a long-term trade once it's on, right? The whole management phase here, it's about the entry, right? And that's where you need to consider your capital management. You want to survive that initial price action at this break level. And as I said, if it's a fundamental on both barrels, as I said, US and yen in this situation, well, it's easier. But say we only had the US fundamentals turning down. Well, it probably isn't as clinical as this move was. And that's where that 100-point stop loss comes into play. All you need to do is reduce your trade size so you stick to the same capital management structure you've got, get into the trade and see how it plays out. All right. And that's pretty simple, right? It's quite, I would say, common sense. And then, you get to make choices. The key part is identifying the turn, right? As I said, don't worry. It's like 500-600 points away. We're now, like the rest of the market is now going, this is turning. We need to get into the trade. And then you start to see fund managers, hedge funds, all piling out of the carry trade and you're into this opportunity. So that's how you sort of get in to the long-term trade and how to manage it. Any questions there, guys? No? Okay, as I said, that's pretty straightforward. The key aspect, as you know, managing the entry. If we do have a fundamental release, like unemployment's a little bit dodgy because there's so many components, but if they all work together, like we saw, you get a clean move. If it's an inflation number, even better, which is what we have next week. So make sure you're checking this out. I think dollar yen is still for a long-term trade, the one to be looking at, right? Maybe dollar Swiss as well. And that's where that's where you can make some big dividends instead of like coming back to the market and wrestling, with the day in, day out price action and the data, like wrestling with this stuff. Nice to get into a trade that just cleans out to the downside. And that is what we're looking for with these long-term trades, right? And you got to compartmentalize the long-term trade. That position sort of sits to the side. It's going to be hard when you're making money and you can see money coming into the account each day. You've got to try and forget that. Think of your targets, which could be, the next key level on the downside, and try and keep the cash rolling in from that opportunity. All right. All right, guys, thanks for joining me. And we'll give you some more updates. There's lots of updates coming on the site. Try and keep you in touch, simplify your trading process, and give you some tools to sort of help keep making consistent cash when the opportunities arise. All right, guys, have a good one. All the best. Cheerio.